Hello friends, welcome back. So we want to talk about the last approach, which is the expenditure approach. People spend their incomes. Whatever money you receive, you either spend or save. And when you spend on something, you are buying that particular thing at its price. Right. Even if you save, in the future, by all means, you consume that money you've saved. So another approach to calculate national income is to use the expenditure approach. The total expenditure on final goods and services. Normally, it's equal to the value of the goods and services produced. If you produce 100 chocolates and all the 100 chocolates are bought, how would you get the national income or the income received? If you don't want to go to the producer, you can take the expenditure, how much was spent on the chocolate, and that also gives you an idea of the monies people are having. So that is also a very wonderful approach. Any output that is not sold to consumers is bought by producers under the expenditure approach. So if you produce something and it is not bought, it doesn't mean that it cannot be calculated as part of. We assume in the expenditure approach, we assume that you, the producer that produced it, because it is not bought, you have bought it yourself. Because by all means, in the future, it will be bought. So that is also added, and it is normally called inventory investment. So this equation is normally used for the expenditure approach: C plus I plus J plus X minus M. X minus M is export minus import, and it's called net export. So if in any book you see X and there's a bar at the top, it means X minus M, right? So this function or this equation is normally called the aggregate or total expenditure. So with the expenditure approach, we have private consumption, which is the C. We have gross investment expenditure, which is the I. That is normally investment by firms and also residential buildings of household, and inventory investment, which we've talked about. And we have G, which is government expenditure. You know, government spends on roads, education, medical facilities, and all and what have you. So all those are classified under government expenditure. Salary to civil servants are classified under government expenditure. But please note, transfer payments are payments made not for economic activity. An example of a transfer payment is an unemployment benefit. If the government is giving people money because they are unemployed, they have not engaged in any economic activity, so it is normally not added to the government expenditure. But if an expenditure is made at the cost of taxpayers, it is not considered as an expenditure on market prices. So basically, government expenditure is expenditure made for economic activity by the government. And the next is net export. Net export is export minus import. So it includes domestic export and also re-export. If you import a good and you export it back to another country because it's exported, it is considered as part of the calculation. Now the reason why we consider re-export as part of export is because import has been taken care of already. So if you export the commodity again, you earn income, right? So items that are excluded from national income accounting are second-hand goods. Second-hand goods are not included in national income. As I mentioned earlier, intermediate goods, goods that are not produced finally, they have not gotten to their final stage, are not included. Non-marketed goods or services, and also volunteer work. Volunteer work, people have not received income from what they have done, so such work are not considered as part of the national income. For instance, if you have a housewife, we cannot, because the person is not taking salary, we cannot consider her services as part of the national income. And the last is unreported or illegal market transactions. All these are not considered as part of national income. For instance, in Ghana, prostitution is not legalized. So the money they earn, we cannot go to prostitutes and ask them, how much do you earn? We want to calculate national income. They are illegal activities, so they are not considered. They are not calculated as part of national income. Now let's look at the benefits. We are just drawing the curtains down. Let's look at the benefits or uses of national income statistics. So the first benefit is that it reflects and also compares the standard of living of different countries. So if you want to compare Ghana and Nigeria, which country is better off and which country is worse off? National income is the first thing to look at. If you know the national income, you can calculate per capita income. Per capita income is national income divided by the population. And per capita income carries the idea of if the income of the country is divided among all the people in the country, how much will everyone get? So if we compare the per capita income of Ghana to Nigeria, and we realize that Ghana's per capita income is lesser than that of Nigeria, we can confidently say that Nigeria is doing well than Ghana. So it helps in comparing the standard of living of two countries. That is how come the United Nations can say that United States of America is doing better than Ghana, because their per capita income is far higher than Ghana's. Okay, the second is it provides information to the government and firms for economic planning. So the national income, in calculating national income, all the information we get from the various sectors, the primary sector, the secondary sector, the tertiary sector, it helps the government to know where to invest. And if we know the per capita income of Ghana at the moment and it is very low, it gives the government an idea on what to do to up the per capita income. So all these helps in economic planning. The figures are so important. So important. And the third is it reflects the economic growth of the country. It gives you an idea on to know whether the economy is growing or the economy is not growing. So normally in Ghana, we use the GDP instead of the GNP. As I mentioned, getting the GNP is very difficult. So any change in GDP shows the growth of the economy. It means, production is moving on well. If we calculate the national income for this year, comparing it to last year, and we realize that this year's national income is lesser than last year's, that means our economy is not growing. The last thing we want to look at is limitations of national income statistics. It's beneficial, but there are some limitations it has. The first is it is likely that we will understate the standard of living or welfare of people in the country, all because we can have a very good national income, but so many people are poor in the country. Why? Because very few people have so much income and the masses have less income. So it's likely to be understated. The standard of living is likely to be understated because there is inequality. The second is exclusion of leisure. Leisure is something very important. People can be working so hard and they wouldn't even have very good health because they don't have enough leisure. Leisure is a part of our welfare, but national income does not take into consideration leisure. So if you enjoy leisure, you are improving your welfare, but then your income might be low. So if we calculate national income and the national income is so high, people are not having leisure, we think the economy is doing well, but people are not doing so well in their health or in their welfare because they have sacrificed leisure for income. So that is something national income does not take care of. And also it excludes non-marketed and unreported transactions. There are some transactions that are earning people a lot of money, but because some of these transactions are not reported in national income, we might think that people are not earning anything at all. So that is also one limitation of national income. In as much as it can understate the standard of living, it can also overstate the standard of living of people in the country, also because of inequality. So in the national income can be very low, and because of that we might think the people are not really enjoying a very good standard of living. But because of inequality, there might be few people who are extremely poor, and most of them are very rich, very rich. Looking at the national income, when we spread it across, we are finding an average. So it might not give us an idea of the fact that a lot of people in the country are very rich and very few people are very poor. By that we are overstating the standard of living. That, oh, the figure is so high, so the standard of living is very good even for the poor people in the village. And the last is it excludes exclusion of the undesirable side effects of production. It excludes some of the side effects of production. National income, for instance, the output approach takes into consideration what has been produced, but it doesn't take into consideration what has been destroyed as a result of the production. Air pollution, and that is harmful against our health and all others, it doesn't take into consideration. For you to get real value of something, you need to subtract the cost from the benefit. But this, for national income, it only considers the benefit but does not consider the cost. So we'll end here. Thank you so much for your attention. If you have any questions, you can post it on our chats. Have a wonderful time. Bye-bye.